In this episode, I'm going to answer the following questions. Should you invest in airline stocks? And do they provide great returns over the long term? Stay tuned and we're going to answer those questions right now. Hi, my name is Kanwal Sarai and welcome to the Simply Investing Dividend Podcast. In this episode, I'm going to cover the following three topics. First, we'll start off with a quick discussion on the airline business. Then we're going to look at some airline stocks. And then we'll look at the rate of returns that you can expect with some of the airline stocks we're going to look at today. Let's get started with topic number one, the airline business. Now, before we get started, I want to mention to everyone that I am an aviation enthusiast and have been for a very, very long time. I love everything about air travel. And I think that the flight crew, the ground crew, everyone does an incredible job in keeping the planes flying. And it is such a great way to travel. And as an aviation enthusiast, I can just look at an aircraft, for example, this one on the screen, and tell you right away that this is an Airbus A320 versus this one here, which is a Boeing 737. So as an aviation enthusiast, I love airplanes, love air travel, love to do plane spotting as well. However, today's episode is to focus strictly from an investment perspective. So when it comes to airline stocks as an investment, are they good? Are they bad? How are they going to perform over the long term? So that's what we're going to look at in today's episode. So let's get started with our first topic, like I mentioned, the airline business. The key to remember here is that the airline business is very capital intensive. What that means is that it takes a lot of money to run an airline. Planes, for example, are very expensive, whether the company is going to buy them or lease them. Up on the screen here, you can see just two examples. A brand new Airbus A320 is going to cost over $100 million. And if you're looking at something bigger, like a Boeing 787, the cost for that is going to be over $338 million. And that's just for one aircraft. Think about all of the aircraft, planes that companies are flying with today and the different types of planes, and then the interior work, all of that just adds to the cost of the planes. But then the cost doesn't end there, right? Then you're looking at all of the major airline costs. So aircraft maintenance is a very big cost. Fuel, the cost for the flight crew, the ground crew, landing fees. Those are the fees that airports charge every time an airplane lands at one of their facilities. You're looking at the cost of insurance is very high, and then of course marketing and sales. The three biggest areas here that are variable and that do change over time is number one is going to be fuel. So the cost of fuel. Every time the price of oil goes up, the cost of jet fuel goes up as well. And a lot of airlines many years ago added a fuel surcharge. The surcharge is still there, pretty much never went away. Every time the cost of fuel goes up, that cuts into the company's revenue and it increases the company's expenses. Now, when we talk about flight crew and ground crews for major large airlines, most of the time those crews are unionized. So every couple of years, there's a threat of strikes. The companies have to increase the salaries for all of either the flight crew or the ground crew, or any of their employees, right? So that also is an added additional cost increase that happens frequently over the long term. Now, all of those costs have attributed to a number of airlines that no longer exist. You can see the list up on the screen here. Eastern Airlines, Southeast Airlines, Aloha Airlines, New York Airways, Pan Am, TWA, Continental, WOW Air, US Airways. Those airlines no longer exist. And again, because running an airline is an extremely difficult job and it is extremely capital intensive. Now, some of the airlines here have gone through bankruptcy before. They're still around today, but they have at one point or another in their history had gone bankrupt. Delta, for example, went bankrupt in 2005. United declared bankruptcy in 2002. American Airlines did the same thing in 2011. Air Canada also went bankrupt in 2003. So, for example, the Air Canada you see today, the company that trades on the Toronto Stock Exchange, is a different stock symbol altogether. It is a new corporate entity. The original Air Canada went bankrupt and was out of business in 2003. So anybody who had shares in Air Canada prior to 2003, those shares are worth nothing. They were delisted off the exchange because of the bankruptcy. The stock value went down to just zero. So the stocks that trade today in the Toronto Stock Exchange for Air Canada under the ticker symbol AC is a brand new corporate entity. So the airline history has been troubled in the past. There's been bankruptcies, there's been companies that have disappeared and are no longer in business. So what are we going to look at in today's episode when it comes to airline stocks? And that's our next topic in this episode here. So we need to narrow it down. We're not going to be able to evaluate or look at every airline stock in the world. So what I did is I started with the largest public airlines by revenue. And this is listed by Forbes in 2023. So that's the data we're going to look at. You can look at the list of companies on the screen. They're listed in order from highest revenue to the lowest revenue. These are the top 10 largest public airlines in the world. So at number 1, we have Delta. Then we have American Airlines, United, Lufthansa, Air France, KLM, Southwest Airlines, International Airlines Group, Turkish Airlines, China Southern Airlines, and then Air Canada at number 10. Now, as dividend investors, what's important to us is the dividend. And you've heard me talk about the dividend many, many times. In all of my episodes, we talk about dividends because the dividend is the company sharing its profits with you, the shareholder. So every time the company pays a dividend, if let's say a company is paying a dividend of $1 per share, you own 1,000 shares, you're going to receive $1,000 every year in cash. And that money gets deposited into your trading account automatically, again, as cash. So you can spend that money if you wish, or you can reinvest it. It's entirely up to you. So what we want to focus on is we've got a list of 10 airlines up on the screen. Are any of them paying dividends today? And the answer is yes. There's only 3. So out of 10, only 3 companies are paying dividends today. So that's Delta, Lufthansa, and Southwest. So for the purposes of this episode, I'm going to keep Lufthansa out of it because they don't trade in the US or in Canada. And I don't want to complicate things by putting in currency conversions, for example, with the dividend, the stock price as well. Lufthansa trades in Europe, not in Canada and the US. So I'm going to leave Lufthansa out of it. By the way, the dividend isn't very big, and you'll see with it's in line with the other 2 companies anyway. So for the purposes of this episode, we want to keep it simple. We're going to stick with Delta and Southwest Airlines. So let's take a look at Delta. I originally wanted to go back 20 years, back to 2004. However, Delta, like I mentioned before, had gone through bankruptcy. It reemerged as a new corporate entity in 2007. So that's as far back as the data goes for the current company Delta. So I'm going to start with 2007. So it's not bad. We're not going to be able to go back 20 years, but 17 years is good enough. So if you look up on the screen, you can see the annual dividend per share. And you can see in 2007, the company did not pay a dividend. In fact, they didn't pay a dividend until 2013. So you can see up on the screen, the dividend is 0 from 2007 to 2012. And then they paid a dividend of 12 cents a share. Then they raised the dividend the following year to 30 cents a share. Then the dividend went up again, and it kept going up until 2019. And you can see the dividend in 2019 was $1.51. But then the company cut the dividend in 2020 to 40 cents a share. That is a huge drop, right? Every time the company increases its dividend, that's more money in your pocket. Every time they decrease the dividend, that's less dividend income for you. And then you can see that in 2021 and in 2022, the company eliminated the dividend altogether. And that is a risk for dividend investors, right? You don't want to invest in a company that's going to cut the dividend, because then your dividend income is zero. And the dividend is basically the return on your investment while you hold on to the shares. And if the dividend is eliminated, then you're not making any money while you're owning those shares. In 2023, the dividend went up 20 cents per share. And as of this recording, the dividend is 40 cents a share. So you can see that the dividend wasn't given to shareholders initially for many years. Then they started the dividend, but then they reduced it, and then they cut the dividend for 2 years, and then they reinstated the dividend again. So that is not the track record that we look for as dividend investors. But nevertheless, let's move on to Southwest. So you can see that Southwest, of course, has been paying a dividend since 2007, but they didn't increase the dividend until 2012. So the dividend remained the same, and then you can see they paid a dividend, the dividend went up, but then again, similar to what Delta did, in 2020, they reduced the dividend. It went from 70 cents a share to 18 cents a share, and that's a significant drop. And then the following year in 2021, they cut the dividend completely. So that was not good news for dividend investors. Then in 2022, the dividend came back at 18 cents a share. In 2023, it was 72 cents a share. That's good news. But as of this recording, it remains at 72 cents a share. Now, to be fair, we still have many months to go in the year 2024. So the company has an opportunity, if they want to increase the dividend this year as well. So again, you can see the dividend history over the last 17 years, a little bit better than Delta's. But again, there was a dividend cut. There was a dividend reduction first, then a dividend cut. But anyways, let's keep moving forward. And so what we're going to do is we're going to look at Delta and Southwest. And what I've added is 2 other airlines. I know they don't pay a dividend, but I've added United Airlines and American Airlines. And the reason for that is I know I'm going to get comments in the videos. People are going to say, well, what about airlines that don't pay dividends? Maybe they outperform the ones that do pay dividends. So for that, let's add them in there. And so we are going to look at 4 companies. Now, just as a quick reminder, you can see the annual dividend per share for Delta is 40 cents as of this recording. For Southwest, it is 72 cents. And of course, United and American Airlines do not pay a dividend, but we're going to evaluate those companies anyway. We'll take a look at them and see how well they performed. Now, just to give you an idea of size, again, these are large companies. They're in the top 10 of the largest publicly traded airlines in the world. Delta has had revenues, and we're going back to January 2023. You can see the revenue was a little over $53 billion. Southwest was a little over $24 billion. United Airlines over $46 billion, and American Airlines at over $52 billion in revenue. You can see the number of employees up on the screen. It ranges anywhere from 95,000 to 129,000 employees. So Delta's got 95,000, Southwest 66,000, United Airlines 92,800, and American Airlines at 129,700. So now we have a good picture of which companies we're going to look at, the revenue of these companies, and number of employees, and we can see that 2 of them pay dividends, the other 2 don't. So now let's move on to our last topic in this video, which is to look at the rate of return for those 4 companies. Now remember, we're only going to go back 17 years since 2007, and we are going to include dividends in the rate of return for the 2 companies that are paying dividends. So you can see that Delta had a rate of return since 2007 of 180%. Southwest Airlines had a return, again, including dividends, since 2007 of 75%. United Airlines didn't do as well as the other two companies and returned 9%, 9.75% to be exact. American Airlines really performed badly during this period since 2007. Now, American Airlines doesn't pay a dividend, so what we did is we looked at the stock price in 2007 and we look at the stock price as of this recording, and we can calculate the rate of return, and it comes out to minus 72.96%. So anybody who invested in American Airlines in 2007 would have lost money. United Airlines didn't do, it was a positive return, but it was 9.75%. Southwest, again, 75% return. Delta performed the best out of these four companies at 180% return. Now, as dividend investors or any kind of investor, we're always looking at, could we have done better? Now, this is the performance of the airlines, and I've already talked about in the beginning, it is a very capital intensive business. Every time the cost of fuel goes up, that increases the company's expenses. Then they have to deal with the unions, which every couple of years are demanding more money for their workers. And then the landing fees, maintenance, cost of the planes themselves. It is a very expensive business to run. But as an investor, could we do better elsewhere? So let's take a look. I'm going to add two other companies to the mix. These are not airlines, but they are dividend companies. They are strong dividend payers. So we're going to mix it up here with two completely different industries. We're going to look at McDonald's and we're going to look at Texas Instruments. Let's take a look at McDonald's. Again, from 2007, because we want to compare the same time period. From 2007 to as of this recording, McDonald's, the dividend used to be $1.50 per share. Now the dividend is $6.68 per share. That is an incredible increase in the dividend. Now you can see it up on the screen. We list the dividend per share for every year since 2007. Has the dividend ever gone down? No, it hasn't. Has the dividend ever been eliminated? No. The dividend has gone up every single year. In fact, the company, McDonald's, has had 48 years of consecutive dividend increases. And remember what I said before, every time a dividend goes up, that's more money in your pocket. Now, think about how many recessions, how many market downturns, how many crashes we've had in the last 48 years. But yet McDonald's has continued to not only pay a dividend, but also increase the dividend every single year. Now, if we take a look at Texas Instruments, again, looking back at 2007 to now, the company has increased the dividend from 30 cents a share back in 2007 to $5.20 a share now. The dividend has gone up. The company has had 21 years of consecutive dividend increases. So that is an incredible track record, right? Dividends are not guaranteed. The company can cut the dividend anytime they want. They can eliminate the dividend anytime they want. But when you look at companies like McDonald's or Texas Instruments, you can have a high degree of confidence that the company will not only pay you a dividend, but also increase the dividend as well. So now we go back to our four airlines we were looking at originally. You can see the rate of return. Delta, 180% return since 2007. Southwest, 75% return. United Airlines, 9%. American Airlines, negative 72%. Now, how did McDonald's and Texas Instruments do during the same period? And again, we're going to include our dividends in the rate of return. You can see that McDonald's has returned over 658%. And you can see that Texas Instruments has returned over 619%. So those are incredible rates of return. When you look at those and you compare it to the airlines at the top, you can see that you would have done much, much better by investing in companies like McDonald's or Texas Instruments instead of any of the airlines that we have listed up above. And again, this goes back to because those companies are very expensive. The airlines are very expensive to run. So how can you learn how to invest in companies like McDonald's or Texas Instruments? Well, the key here is to invest in quality dividend-paying stocks when they are priced low. So the key is not just any stock, it has to be a dividend stock. Not just any dividend stock, it has to be a quality stock. And not just at any price, it needs to be priced low because it's important when you make the purchase and the investment into that company. So how do you know when you're looking at any company anywhere in the world, if it's a quality stock and if it's priced low? Well, for that, I've created what I call the 12 rules of simply investing. You can see them up on the screen here. These 12 rules are basically your checklist. A company has to pass all of the 12 rules before you can invest in it. Let's take a look at rule number 1. Do you understand how the company is making money? If not, skip it, move on to something else. Rule number 2, 20 years from now, will people still need its product and services? Rule number 3, does the company have a low-cost competitive advantage? Rule number 4, is it recession-proof? This is so important to today's episode. We took a look at the airline stocks. Are the airline stocks recession-proof? Are the airline companies recession-proof? Well, to answer that question, think about this for a moment. If there was a chance that you may lose your job or there's a recession, are you going to get on a plane and purchase an expensive trip overseas? Of course not. You're going to save your money and you're going to travel locally and you're going to avoid traveling by air because that's expensive. It's an expensive exercise. And so we saw that in, of course, March of 2020 during COVID. Because of the lockdowns, travel was shut down. We saw that after 9/11, a lot of the travel industry collapsed after that. So, and even in 2008, 2009, the financial crisis, right? People were losing their jobs. So the airlines, in my opinion, are not recession-proof. So they fail rule number 4. So automatically you would skip them. Even if they pay a dividend, you would skip them and move on to something else. Rule number 5, is the company profitable? Rule number 6, does it grow its dividend? Rule number 7, can the company afford to pay the dividend? Rule number 8, is the debt less than 70%? Rule number 9, we want to avoid any company with a recent dividend cut. Rule number 10, does it buy back its own shares? Rule number 11, is the stock priced low? So there's 3 things we look at: the PE ratio, the PB ratio, and we look at the current yield and compare it to the company's average 20-year dividend yield. If the current yield is higher than the 20-year average, then we consider the stock to be priced low or undervalued. And rule number 12, keep your emotions out of investing. For those of you that are interested, I've built the Simply Investing course. It's an online self-paced course. It's in 10 modules. There's video modules. Module 1 covers the investing basics. Module 2 covers the 12 rules of Simply Investing. Module 3 shows you how to apply those 12 rules to any stock anywhere in the world. Module 4, you learn how to use the Simply Investing platform. Module 5, I show you how to place your very first stock order. Module 6, building and tracking your portfolio. Module 7, you learn when to sell, which is just as important as to know when to buy. Module 8, reduce your fees and risk, especially when it comes to mutual funds, index funds, and ETFs. Module 9, your action plan to getting started right away. And Module 10, I answer your most frequently asked questions. I also have the Simply Investing platform that we built out. It tracks over 6,000 companies in the US and Canada every single day, and it applies the rules to those companies. So you can immediately see which companies to avoid and which ones to consider. If you're interested, you may want to write down this coupon code, SAVE10, SAVE10. SAVE10 is going to save you 10% off of the course or the platform as well. If you like today's episode, be sure to hit the subscribe button. Hit the like button as well. We have new episodes out every week. And for more information, take a look at our website, simplyinvesting.com. Thanks for watching.